Good morning, everyone. Welcome to Career Launch. Today we have Priority Home Lending helping us out on some interest rate buy downs and some tactics and some things that will help you out with your buyers, especially how to make things work even with your sellers. Rather than doing a price adjustment, you might be able to offer some 3-to-1 buy downs for the buyers to be able to have a lower interest rate. And it's just a different strategy to help get some people off the fence and to also give you more knowledge. So let me go ahead and share our screen. Here we go.
Full screen.
Boom. Can't miss tip.
Can't miss.
Can't miss.
Can't miss
Can't-
it.
No,
You
you
just
can
gonna
try,
do
but
right
you
arrows.
can't.
You can try, but
You
you
can
can't.
try, but you can't. All right. Well, thank you for all showing up today. Appreciate it. Hope you enjoyed the bagels. We don't have virtual bagels. It'd be great.
No virtual base.
Virtual food.
That's right.
So basically when I wanted to go back, so basically the idea today, Lee and I were talking about is what can we do to combat higher interest rates, right? But more importantly, how to get people off the fence and to feel comfortable that today, like buying now is okay. You know what I mean? I think, and we've been talking about this a while, like the mindset behind someone, why does someone want to buy or not buy, right? Because when they meet with you guys, they're wanting to go buy a house. And I think sometimes they just need to say it's okay. It's okay to get some knowledge. It's okay to take your time and that kind of thing. And so it just, for us, is trying to figure out how we can make these strategies easier for you or demonstrate to people that it's pretty straightforward concept. And if now's the time to buy, great, but at least we can provide as much knowledge so they can do it and feel comfortable. Because I think we were talking about, what makes people uncomfortable, what makes people comfortable to get off the fence? Like, what do you think, if you're making a decision, what's something that you think about that, so you get off the fence? Any ideas, anybody? When you're making a decision, you're like, you're hemming and hawing. How do you get out of the hem and the haw? What makes you make that decision? Okay.
Well,
Education. Learning about it.
Usually you weigh the benefits, right,
Yeah.
of making the decision and what's the pros and cons?
Mhm.
Usually you
Right.
go through and you're like, what,
Mhm.
yeah, why should I do this?
Yeah, so, but what information do you need to make that decision though? Right? You need to have knowledge, right? You got to know what's going on because you don't have the information. It's hard to make that decision, right?
Yeah.
I see a lot of people are like, yeah, I want to buy, but I'm not sure. So they don't know. So then they just don't do anything. And then they get frustrated. And then they're like, you talk to them, they get just, why are you upset? Well, I just don't know. Well, I don't want someone to go show me a house right now. I just want to know the information so I can make that decision if now it's time to buy.
Oh.
And if they have that decision, then they're going to use you, right? So then they're going to, hey, you've got the relationship, but once they feel like they're good to go, then you're off to the races and you do what you do best is show them houses and get them excited. So I think we were talking about, I think knowledge is one of the big appeals. The other part was feeling confident in making a decision too. So when you feel confident having the knowledge and you think it's good for you, then you'll make that decision. It's just, those are the kinds of things this is what I'm looking for. We were just kind of brainstorming on different reasons why people make the decision or not. And so, so it just basically, is it worth it? Is it not worth it? And the more information I think you have, the better way you can make your decision. So with that regard, that's what this part of this is what it's about too. So next slide. So we've talked about this in our meeting about home prices continue to keep going up, right? And I think that's a great thing to make that decision. But I know home values are going up. It's much easier to get someone to buy than, hey, look, if home prices are going down, right? So I think 2007, 2008, 2009, this was very difficult to do on that. So we've talked about this in the meeting, showing how high, what the pace and of home appreciation is going to be. So the next slide. And then here, obviously, we did the betting against Champlin. We talked about this in the meeting, but this is what I show when we talk to clients. And the next slide is just going to be our value of what we sell is the return on investment on that, right? So when we talk about why is home values going, home values are going up, but what does that mean to the buyer? It means your equity, generational wealth. This is how you do that stepping stone to get to the other places you want to be.
It's all about the ROI.
Yeah,
The
for sure.
return on the investment. I love the 73, 7 and 1 since 1941.
Yeah,
That-
I mean, and then I think, and it's not, and this is what I was telling someone yesterday. Home values going up is not linear. You're never seeing this, right?
Yeah.
What you're gonna see is boom, 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 jump, right? So if you had the home in 2018, 2019, whatever it was, you're about here. Then all of a sudden, 2021 hits 2022, what happens? Values just shoot up. So now instead of being here, now you're up here. Once you get to the next level, and it might stay this way for a bit, and then we'll jump back up again. So that's what I just try to tell. It's like a tier thing. It's not so much every year it's going to continue to do that.
Man, I
But-
wish I could go back in a time machine and then buy a bunch of houses in 1945.
Imagine the repairs you'd have to make. I'm kidding.
Well worth it.
Yeah.
But yeah, but that's the idea. You can
Oh.
just see, but you can, when you look at these numbers, you can see 1947 it jumped up.
I know,
20%, right?
24%.
But then you can see through the course of the year, you'll have jump ups, 15, in the mid-70s jumped up. Then, in the late 80s, and then you go through, and then the early 2000s jump up. You went down a little bit, obviously, there's other times, but then the last couple of years, it's 10, 19, it's that jump. And then if you can get people making that jump, that's what you want, and they have to get off that fence to do that.
Mhm.
So, next slide. So how do we get them to take the jump? Leap of faith, right? It's not really a leap of faith if you have the information and knowledge, it's not really a leap, so that's what we're trying to do. So, next one. So this is what I did. What was that?
That was somebody's ringtone.
Oh.
I love that.
So anyhow, we try to make this as realistic as possible, okay? And so here's this is what we just talked to a buyer with, right? We say, hey, look, if you're renting now and you're paying $4,000 a month, right? And if you buy, you'll have to pay $5,400, right? It sucks. I get it, but there's gonna be some pain, I guess, trying to get to where you want to be, and we can try to limit that. But again, if you take a look, and if you're renting at $4,000 a month, right? So over the next 9 years, if you will, your rent might go up to $6,300. Okay? And your monthly expense, and so you can see the difference in payment. So over a total of a 9-year period, you'll pay $588,000 in interest and principal and payments and everything else. When you rent, you'll be at $554, so it'll be cheaper, right? But this is assuming interest rate is 7.25%, and rent annual rents will increase maybe 6%. Maybe it goes up, maybe it goes down, but that's just the idea. Okay, so you go, well, why would I mean, I can save 30,000 by renting than owning, right? So then the next slide. But if you take a look at the appreciation that you can get, if it goes 5.5% over a 9-year period, home might be worth 1.1, right? But you've also paid down $78,000 on your loan too.
Mhm.
So now you've got that, I paid it down, I've got appreciation and I've paid down the mortgage balance, now I've got a ton more equity. So over a 10-year period or 9-year period, that's not bad, right? I mean, that's just the compounding effect of paying off the mortgage and the home appreciation. Now, I mean, I've lived in Seattle since 1999, right? So our home price is usually doubling every 10 years. That was usually the thought, right? But now, I don't know, sometimes it goes up or goes down, but I would think home values now are much higher than they were in 5 years ago, don't you think?
Oh, yeah.
So it's that same old Ronald Reagan question, right? Are you better off than you were than 4 years ago? It's the same thing. Are you better off if you buy now?
Reagan reference.
Yeah.
Niche.
Sorry.
Yeah. It's niche.
But that's kind of, so after 9 years, that's kind of the deal. And if you go to the next slide, I said, well, okay, maybe not 9 years, what happens after 5 years, right? So if the home is in 5 years, if you do 5.5, maybe it's closer to 9, I don't know, something like that, but you're definitely going up. And you might have those years where it might stay low, or you might get one of those years where if rates drop and the home values go back up again, you might see an easy 10% appreciation on the home. And then you also pay 37,000. So you've got appreciation plus the amortization gain. That makes sense?
Mhm.
So that's the idea, just trying to show people, it's like, you don't go out buy now, just think about it. And if it makes sense for you, then this is the time to buy. So the next slide. So then if you can take a look at the net gain. So we're just saying over a 5-year period, you might get about 162,000. Over the 10-year, maybe up to 543, something like that. But that's just the idea, the appreciation. On it, you get the appreciation gain, the amortization gain, and some tax benefit too, because you get running interest. That makes sense?
Mhm.
Does that sound compelling? I mean, I don't know. I'm just trying to, this is how we kind of talk to clients about this.
It's funny, yesterday, I was making a phone call, checking in, because my lease and my car is like at the end. I extended it because none of the new cars are out. They're all delayed, and now they're talking about strikes, and I'm
Yeah.
trying to figure out, like, because the interest rates for cars are atrocious.
I don't know. What's an interest rate for a car payment? I don't know. What are,
7.25.
oh,
Yeah,
oh, okay.
yeah, so Yeah, so it's like really bad.
right?
Mhm.
Yeah.
It, even with great credit, amazing
Yeah,
credit
yeah.
and,
Mhm.
it doesn't matter.
Yeah.
So
The interest rate's high.
the rates are just high. So it
Yeah.
was funny. So I was calling the dealer just to see what, any word yet, find out, hear about new vehicles and
Mhm.
any, specials and whatnot. And
Mhm.
so anyways, the lady I was talking to, she's like, yeah, no, we got limited. Like we're not, they're not getting very much and we're not, giving very much because
Mhm.
just because, yeah, the interest rate's terrible.
So
Well, I
you
deal
have-
with this too.
Yeah.
In my industry, she's like, oh, what do you do? And I was like, I'm in real estate,
Yeah.
she's like, oh, so you know exactly what it is. And she's
Mhm.
like, that's funny. I'm thinking of buying a house. She's like, but I don't really know if it's a good time to buy because the rates are so bad. And I go, so then I just kicked in and reversed and just said, well, are you renting now? And she's like, yeah, I've been renting, for years and
What's
I
your
got a
rent
high
payment?
payment and
Yeah.
always goes up. I go, well, right now your interest rate is 100%
Mhm.
that you're paying.
Mhm.
And she was like, yeah, you're right. And I said, well, the equity that you could have gained if you have already bought. Like that's what's gonna happen, because I
Mhm.
explained that,
Yeah,
not
yeah.
only are you paying your payments, it's going down, but equity's building too.
Sure.
Mhm.
And so now you're gaining more and more equity in that investment.
Mhm.
And then the other thing too is like you can refinance as soon as the rates are better.
Mhm.
Correct.
And she was
That's
like,
the- yeah.
what? Wait a minute. I didn't think you could refinance. I thought you have to stay with that loan for a certain time. And I'm like, no.
It's our
No.
mortgage police.
Yeah.
How can I-
Yeah,
really
she
have
was
to-
like, wait,
So like.
I thought I had to stay in that no matter what.
No.
I'm like, no.
So
Yeah.
that's
She
what
was
I
like,
mean.
oh my goodness, I'm taking your info down. Is this Eric?
Well, no, but I think that's the part of the I mean, like, I know it's, because I was thinking of trying to figure it out, right? How do we get people more comfortable? Once they're comfortable, they'll use you, right? So that's the idea is I'm trying to figure out, it's almost like I wish I could talk to people first.
Yeah,
So then I can say they're comfortable, they're ready to go. Then they talk to you and boom, all done, right? And it's hard because they talk to you first. And then I think sometimes in their mind, they're just like, hey, this person's just trying to sell me a house, right? As opposed to
yeah,
what's in my best interest, right? And I know you don't think that way, but I think that's how I would be. What realtor would tell me not to buy? Right? And the realtor I used to buy my house 20 years ago was saying, you buy when the timing is right for you. And to me, that was impacted me to like, hey, okay, I can control what I want to control.
Mhm.
But I think without having the facts and the knowledge, it's tough to make that decision. So that lady was the same thing. She has knowledge. Maybe she feels more confident now or whatever.
Mhm.
Yeah. So we wait for that phone call. Just never give me a call. But that kind of makes sense. That's the idea. I mean, that's the idea of the amortization and the appreciation. It really compounds everything. So then and this I did the same thing over a 5-year period, right? So this is the same thing. So
But this payment, monthly payment.
Is
That's the
going up.
hurdle, yeah.
yeah, that's the thing. So when they go, hey, that sounds great, Eric.
I'd
right.
love to.
Yeah, I'm
have
paying
gains.
1,500 more than I'm at now. I don't know, right? So that's the idea. I mean, obviously this is brutal. I get it, right? But what can we do to strategies to maybe minimize that or make it less painful? Instead of this being a 10, are you comfortable with like a 5, right? Is a 5 paying okay? And so the next slide. So this is kind of what we talked about. So on your sheets, I handed out, the first one's a temporary buy down. So in this scenario, what we're trying to do, again, your current rent is 4,000, okay? You have, so basically what a temporary buy down does, it says, hey, look, if you get the difference in pay, so the first year, the interest rate's 7.25%, okay? The second year, or after the first year, it'll be 2 points below this at 5.25%. And then in the second year, it'll be 6.125. So it's this should be a 2-1 buy down.
Yep.
So it's a 2-1 buy down. Because the reason why you can do a 3-2-1 buy down too, but it's a lot more expensive. And I'm just trying to show you, there's a reason why I did 2-1 buy down. So first year reduced by 2 points, second year reduced by 1 point. Okay, the difference in payment for the first year is going to be $864. So $36.72. Okay, is what you would pay. Then the second year, it goes up to 4,095. Okay, so it's not terrible. Now, mind you, this doesn't include the taxes and insurance. Okay, so we got to add that to it. But the idea is, the concept is, if the taxes and insurance are on top of it, but when I look at these things, we look at basically the principal and interest because we can always reduce that or pay it off,
Yeah.
or refinance. So So anyhow, so you had 3,672, $867 difference, okay? Even if you throw the taxes and insurance on top of that, you're gonna be closer to 4,000 anyway, right? Or maybe a little bit more. So then what you do is that the cost for that first year, so that first year, the difference of $864 times 12 is 10,000. Because you're paying less than what the actual payment is. The payment's 4,500, you're paying 36, so the difference 864 over 1 year, it's 10,371. Same concept. So the next year it's 1%. You're only paying, you're saving $442. It's about 5,303. Okay. So the total cost between these 2 years is the 15,675. That's the cost of the buy down. Okay. You're not paying any additional fee to get the rate. That makes sense?
Yeah.
So you're just, the cost for the differential is this. There's no additional fees on top of it. The reason why there's costs because you're paying less than what the principal and interest payment should be. Okay, so this sits in an escrow account. So this 15,675 sits over by the loan. Okay, and every month when you pay the 3,672, $864 comes from that bucket to make up the difference. Does that make sense?
Mhm.
So then the next month, instead of 10,371, it's reduced by 864. Okay,
So that money stays in an escrow account?
Yep.
Right?
Yep.
Okay,
just like your taxes and insurance.
perfect.
Same thing. So, again, your rate adjusts, I had the 3-2-1, but for 2 years, the cost of the vinyl is the difference between the fixed rate of the loan and the temporary buy down. Essentially, there's a difference of prepaid up front. So what you're doing is you're prepaying all this up front and sitting in a bucket. Okay. Make sense?
Mhm.
So what happens is either the first 2 years, if you use this, great, then it goes to zero. But if you refinance your loan, if the rates drop within the next couple of years, whatever remaining balance that sits here will reduce your actual loan amount. So you never lose it.
That's awesome.
It sits, yes, sir.
Can we use that money for refinance?
Absolutely. Well, it reduces the principal balance. So in other words, if you have $10,000 sitting in this account and your loan, well, I mean, maybe the loan's say it's 665, we reduce the loan amount by $10,000.
When refinance process, there is some expenses that you have to spend, right? There is some.
Yeah, I don't think you can't use, you can't use the remaining balance in here to pay your closing
Except
costs.
for the escrow, right?
Yeah.
Okay, but we have a program that we will pay your closing costs.
Couple fees.
So how about that?
But they'll refinance for free within
Yeah, we're
5
getting there.
years. If you're the loans with them,
Yeah.
Refinance.
so they guarantee, so they'll
Yeah,
make sure the client doesn't have to pay again.
Yeah.
And if they have the buy down and they have money left over, now they just, not only are they getting a better rate, but also they pay down the principal too, so now their monthly payment's gonna go way down.
Then how about this?
Drop insurance too, probably.
Yeah, mortgage insurance, yeah.
Freddie Mac or Freddie Mac, they bought the loans.
it stays with the loan. It's just like your taxes and insurance. The loan is transferred or sold, whatever balance sits in that escrow account gets refunded back to the loan. Okay,
Yeah, that's a win-win.
good, okay. But that's the concept. So the thing is, if it costs you 15 grand, right? Well, if you're paying that 15 grand yourself, I necessarily wouldn't do this because I can pay the 15,000 somewhere else and make extra money on it, right?
Mhm.
But the beauty of this, if you get the seller to pay for it, that's the idea, okay? And so in this market, I guess what I'm saying is that this reminds me a lot of last October or last November.
Mhm.
Rates jump up quickly, people not sure what's to do. Homes are sitting on the market for about, a week, things like a month and a half, right? So things are sitting a little bit, and if you put a house on the market and the market has shifted, you're kind of stuck, now you're chasing it back down. So you might be more willing to pay closing costs or you, first question, reduce the purchase price.
Mhm.
Second question, maybe we don't have to reduce the purchase price, we can only pay 15,000 and save the guy $864 a month. That's way better than reducing the purchase price by 20 grand. And I have a graph on that and I'll show you that later on.
Oh, cool.
So that's the first one. So your first one is a temporary buy down, okay? Second one is a permanent buy down. And the permanent buy down says, look, I don't want to do anything temporary. I just want to pay a one-time fee and get a lower rate. So it's 7.25%, okay? The payment's 45.36. You can reduce the payment to 7% and the payment's 4,424, and you save about $112, okay? You can see how it works. So the next one's 2%, and if you do 3%, you can get 6.25%, which is great. And that gets your payment down to $4,095, and you save $442, okay? Now I have the break evens over here, meaning if I save $442 a month. And it costs me 19, so the point is 1% is the percentage of your loan amount. 1% of 665 is 6650, okay? And the same thing here, it's on your spreadsheet, too, it's the second page. Okay. It's 13,000, so if I take the savings of 442. And I divide it by 19,950, that means in 5 years, or 4 years, I'll break even. So if I keep the loan for more than 4 years, I'm better off going here, okay? But I have to bring in an extra 19,950. But I'm only doing 5% down in my scenario, I don't have the 19,000, so I can ask the seller, hey seller, pay the permanent buy down, pay the 1950, and I get my payment fixed at 4095, okay? Now, the thing is, it takes 4 years. So the downside is, the math works. If you keep it for the whole life of the loan, you're way better off taking this rate. But then you have life happens, okay? Hey, look, I just did this. Oh, I just get transferred 2 years from now. I get transferred. I don't get this money back. It's a one-time fee, okay? The other one was temporary buying down your rate and everything else because you're making the difference. There's a difference between the payment. This is a one-time fee to get a lower rate. So if I move in 2 years, I'm out. Better take the higher rate, okay? The other thing that might happen is what?
Go lower. Rates will
Interest
go
rates
lower
drop,
than the 65.
So the one question would be like, well, how come I can't buy it down to say 3%? If I wanted to do that, the math works, it might cost you $100,000 to do it.
Yeah.
Right? But then it works out math wise, but if you move, you're done. You just spend all that money. So I guess what I'm saying is that if interest rates drop and your refinance is loan, this money is gone. Okay? And if it was at 3%, maybe you do pay the 20,000 and get to 2.5%. I don't know. But we all tend to think interest rates are going to come down. Eventually they will. So then it's so like, do I want to do this bid or not? But some people feel very comfortable with this too, right? So this is just different scenarios. So I'm not a big fan of paying points when we know we're going to refinance as soon as, because if you're at 6.25 and the rates go to 5.5, you're out of this loan. But if you're at 7.25, any dip in rate, you might be able to refinance and you might do it multiple times, right? Take advantage of it. But that's what most people see. This is the one that we've been using a long time because people want to pay it, or you might get a little extra cash to do it versus the temporary buy down. Okay,
Or
those are the two
to
big ones.
qualify too, you have to do a permanent buy down.
Yeah,
to
so that's a
qualify.
great question. So
Yeah.
when we do the temporary buy down, qualifying, we use the actual fixed 30-year payment. We don't use the temporary buy down rate.
Oh.
Okay. On
But
this
in
one, we use the actual buy down rate.
Oh.
Okay. Great
Well,
question.
that
Thank
is
you.
a good-
It's
That is a
important,
big
yeah.
difference.
Yeah, so can you
sometimes
go back one slide?
Yeah, sometimes you do have to.
So we're not qualifying on this, we're gonna qualify them on this. Okay?
Yeah.
That's a great point.
Mhm.
Yeah, maybe that's the idea.
That
So
might
then-
be the only like real reason why you would even want to do that in this
We do,
market.
correct. If I can't qualify, but I can do it over here, that's what you do. Okay? So yeah, and so then the next part, so the next one here is here. So not only is the power of the refi, right? That's the idea, right? So the refi in 5. So if we do the loan, we refinance your loan within the next 5 years, we'll pay your closing costs. Okay? And if you want to pay points when the refinance happens, you can do that. You can pay an extra fee. I'll cover your costs. You can say, look, I want to pay the 2 points because I want to get down to 4% because I don't think the rates are going to change. Fine. And if I have enough equity, I can roll that right into the loans. I have to bring anything out of pocket.
Wow, yeah,
Right,
that
so the
definitely
idea
would be
is-
the way to do it.
You get in here, you do the lower rate first, interest rates drop, refinance into it. Yeah, you're not paying, you're gonna pay more than what you're paying for rent, but you're not, if you do it right, hopefully you're not paying the full 4,500 every month, okay?
And you can also do a permanent buy down. And then also do a temporary buy down on top of it.
You can stack it on top. So in other
Yeah.
words, you can do both.
So you can permanently buy down to like 6.75 and then do a temporary buy down from 6.75.
And the reason why, the reason why you might do that is qualifying,
Mhm.
right?
Wow.
Hey, I can't qualify at 7.25, I can qualify at 7. So I gotta pay the 1 point to get it down, but I'll do the temporary buy down, okay?
To have more of an effect
Yeah.
on monthly payment and
Mhm.
affordability.
Yeah.
Yeah.
But
so
again,
you
there's
can do
more
both.
cost to that. So this is, and I'll bring this up. So the
Get
thing
rid of it.
is, and I don't know if I can't remember if it's in the slide or not.
Yeah.
So when we ask these costs, right? So the thing is, if you're only doing 5% down, the maximum seller concession you can get is 3% of the sales price. So you can't ask for more than 21,000 in this scenario at a $700,000 purchase. So that's why I have it at 15. If I did the 3-2-1 buy down, the cost is probably like 30 grand, and you're like, that defeats the purpose of what we're trying to do. Okay? So the maximum seller credit, if you do 0 to 5 down, is 3% of the sales price.
But if you put more down, then you can
Yep.
ask for more. And FHA has different ones, VA,
Yep.
all different limits.
So next. Okay, so here's the power of the refi. Okay, that was my arm. I took it this morning. I was like,
Yeah, I saw that.
Pull that up, man.
Yeah.
So if your current payment is 45.36, okay? And suppose we do a refinance in 2024 to 5.5%. You save $760 a month. Okay? And even if you're like, hey, I don't mind paying points on the rate if I want to, the 760 will cover any cut. You'll break even so fast. You know, you still have title and escrow that you have to pay when you close.
Yeah.
But that'll make it up for it in 2 seconds, right? So yeah, so you save that. And then maybe next year, hey, guess what, Bob? Just so you know, rates went down to 5%. Let's refinance. I got you to 35.7, save you 9.97, right? And then maybe in 2026, we get it down to 4.75, you know, and then your payment be 34.6. Forget the points. Let's just look at that.
Yeah.
But that's the idea. Now you're at $3,500, right? Versus the payment of 45. So the idea is you get in, you get the compound, you're getting that compound effect of appreciation, plus you're paying down your loan. You know, you're getting equity in the house. And then equity could be used to buy something else, right? That's the idea. You're probably not going to be here your whole life, but for the next 3 or 4 years, and most people hold on to the house 5 years, which tell them, you might be able to capture this and get your payment down. So now you've bit the bullet. You may have paid the 4,500, maybe you're paying 4,200 or 4,100, whatever it is. And then you get your payments done in a couple of years or something like that. That's the idea. Does that make sense?
And we have alerts set on like every closed loan, what their interest rate is and when a refinance could make sense. So we set alerts, so we keep an eye on it, and we'll call them, go over the costs and tell them like, this is technically how much savings you could have in a month. If we just, and what the cost out of pocket.
Yeah, in
What it
20
looks like.
This is where we made money, okay?
the
In
refinance
2020,
scheme.
all the years we did loans from 2007, I've been in the business since 2003.
Mhm.
All the deals I've been waiting and waiting. And I remember when I was sitting in my house, couldn't do anything. And I see the 10-year treasury, we talk about the 10-year treasury, go to like 1. I turned to my girlfriend and I said, you're not gonna see me.
Yeah,
So that we gotta make
Bye.
it, we're making hay. This is good, go time.
Yeah.
And so I would call clients in the past. I'd say, look, hey, I'm gonna save you $1,000 a month, get rid of your mortgage insurance, no cost, no nothing. Well, look, do you trust me? Yes, done. You just get them locked in, and that's what you do, right? I mean, if I told you, Eric, and said, I'll save you $1,000, you'd be like, just do it.
Yeah.
So the idea is, and the thing too, is you don't know. Oh, quick trivia question. What was my salary last year? Just guess. What do you think my salary was?
zero,
Nice, correct. My monthly salary is 0.
zero. We're
I'm
at
just like
salary.
you, I'm 100% commission. I'm calling these guys when rates are low. I love helping people, but I also love making money, right? And so if I can help people save money and make money, they're on my list. That's why Lee and I are calling.
Mhm.
I know, when's the last time you guys have done a refi?
Well, we've done some stress refinances like cash outs or like when people split up and they've got to
Mhm.
refi out of the mortgage.
Oh,
So
Yeah.
it hurts, you know? And
But-
people are trying to find ways to get, you know, if they divorce, they're trying to find ways to keep their low rate. It's like, there's no
Yeah.
way that we
But,
both qualified, you know?
but a lot of this happened but in 2021 and 2022, I did those down payment assistance program loans.
Mhm.
Hey, look, I'm getting you out at 7%. Get rid of the mortgage insurance and roll in that second mortgage on the down payment assistance all into one. And I've done this before. I saved someone $1,000.
Yeah,
We're rolling it all in and you got the equity. So that's the power of that refi. I'm telling you, once it happens, you take advantage of it, because if you wait, you'll lose out. You'll not get the benefit of this. So-
in divorce situations, can one of the borrowers, assume the loan? If they're already in it?
You're already on the loan. Why do
yeah,
you assume a loan you already own?
yeah.
Damn.
Yeah.
Yeah, the thing is, you gotta get
All
them, you gotta
Yeah.
refi. Yeah, I mean,
Yeah.
there's nothing,
Or you know,
or reconcile.
yeah, or you maybe like draft some type of agreement, stays on your
Yeah,
credit report, and then if you ever want to buy something, you can prove that somebody else made the payments.
Yeah.
You know, you just need a 12-month history. Anyway,
all right, so next one. So then, here's our scenario, okay? So now that we've got the idea of what we can do to save money, how does it work for you, right? Hey, I've got my client, we want to put an offer on a home, purchase price is 700,000. down payment is 5%, loan amount 665, max seller concession is 21,000 or 3% of the sales price. Okay, so one strategy, we just, first one everyone thinks, reduce the purchase price to 21,000. That's one option.
Yeah,
If
Or
you're
offer
fine
full
with that bigger
price
payment, yeah.
with the 21,000 in seller credit,
Mhm.
that seems to be more. Or we increase the purchase price by 21,000 and then ask the seller credit for 21,000. Ooh, mind blown. Right.
That's a
If there's
competitive.
no other
property.
offers on the house, that may be one option. If the seller's like, I am adamant, I'm not gonna reduce this or whatever,
Mm,
then maybe you offer it. So basically, you gotta do 5% on 21,000. That's nothing, right? You have to bring a little bit more for the down payment, but you'll get $21,000 in credit. Okay, so those are the three strategies. So next slide. So here's what it is. If I have a sales price of 700,000, 7.25, my monthly payment's 5,403. Okay, taxes, insurance, mortgage insurance, and everything. Yeah. Or I take the seller credit and I can do a temporary buy down like we just talked about and get that payment down to 4961.
That's just a 1-0.
That's that's paying the 3 points, 21,000, right? So I can get the 3 points and get it to 4961 as a payment as permanently, okay?
mm.
Oh, permanent buy.
Now, I don't have the temporary because I don't know how to do it in the system, but you got the idea. Okay,
I can
you can
do
take the
it.
21,000 and you can do it, and we can go back to the other slides, the same thing, right?
You make it an arm and.
Or what you can do is or I can increase the sales price of 21,000. And I do the same thing, get the rate at 6.25, now that payment's 5,084 versus 4961, which is definitely cheaper than this.
Yeah,
So it's a way that you can almost finance your closing costs into the loan. By offering more. Now, the trick is home has to appraise,
yeah.
but in this market, I think it's not a big deal. I think it totally
Isn't
would.
that crazy in the paint? I mean,
Look at the payment.
look at that last one, like how much does the payment go up? Not that much for 21,000.
Mhm.
Mhm.
But 21,000, if you took 21,000 over at 7.25% or 6.25, but I'm saying this is better than this.
Yeah,
So, and a lot of the seller may not say, I'm not giving any credit, but you have to explain the net to the seller is the same, right? Doing this is the same thing, the net to the seller is the same thing over here,
mhm.
same thing. But that's kind of what we talk about. So when we work with strategies and making your offer, we know we're gonna get some seller concession, what do you want to do? What's the maximum? Hey, our maximum is 21, get that, we'll figure it out, okay? Now, the one thing is, just so you know, the maximum seller concession is 21,000. If the loan cost is say only 10,000, I have to use all the cost of the loan for the credit. Okay, so I can only apply credit to cost of the loan. I cannot apply credit to down payment.
Yeah.
So if I do this scenario and suppose the cost is only 11,000 for the loan, then I'd have to reduce the purchase price by 11,000 to get the full credit. So when you rate your offer, you might want to put in there, hey, if seller credit is more, if the seller credit exceeds, or the seller credit exceeds the cost of the loan, we'll reduce the purchase price, because you've already negotiated the 21, right? That makes sense?
Mhm.
Because on the way it says in there, if you put seller it's the seller cost provision, it doesn't say it has to reduce the purchase price. It says, it don't say that. So if you want to protect yourself, everyone assumes that, I think, but you'd rather just have a bulletproof, so there's no issue at the end.
You guys know what he's talking about, right? Like in the 22A, they're saying there's seller credit towards closing costs or prepaids,
Mhm.
et cetera, et cetera. If the seller said, oh yeah, it's $10,000, that they agreed to in the contract, and then when you come down to it, you find out the limit for their credits that they can actually get is only 8,000. Now you got $2,000 left over. That money by default will go back to the seller unless you write something else in.
Yep.
It's a really good idea, probably even to back up even before that, you get in that situation and
Yeah.
actually communicate with the lender, find out what's gonna be their limit.
Mhm.
Now you can form the offer and put it all together and then, have a much better strategy.
And that's
instead
what
of
we
kinda
do.
going
So
in.
when you're making offers on these houses, we're talking with the buyer. We're not gonna have you just, the worst I hate is when I get a contract, I'm, what did you guys just do? I didn't know, you know what I mean? Like, if I know that you're gonna make the
Yeah.
offer, let's work together and provide certainty to the seller, certainty to the buyer that they can close. And know they're not gonna be losing out or anything like that. So we bulletproof that thing. My dad calls it belt and suspenders. You wear the belt and suspenders and make sure you put that extra goes to reduce the purchase price.
Mhm.
So, but that's kind of makes sense, kind of what we're doing.
Yeah.
So then we stack it up, baby.
Stack it up.
Stack it up. That was my dance. So we have our certified mortgage ready program that we've talked about before. The advanced approval, we have an underwriter fully approve the file up front. So we can close in a little 10 days or 10-day ready to close if we need to. If speed's an issue, fully approved, 10-day ready. We also have that pre-approval payout promise, the picture where the guy's like, oh, I'm upset.
Yeah.
That's the one where it says if we don't close because of credit, income and assets, if we've already approved them, we'll pay the seller an extra $5,000. Okay?
Thanks to the side.
So you stack that on top of that, and then we also have the refined five, you know, the sellers get the refined five, then our transactional excellence, right? Yeah, I bet people blow past that. We have not closed late on the deal in years. That's the one thing, our process team is awesome, and when we know when we're gonna close, we have this all dialed in, we will knock it out. There's no doubt in my mind. I wouldn't work here if we couldn't do that. I wouldn't be in the bubble if you're gonna, hey, this ain't closing, what's going on? I don't know, I'm golfing. And so
Yeah.
we're here to do that. So that's the transactional excellence part of that.
In order to get the 10-day close, what do you
You
have to do?
You gotta be fully approved. So it's basically,
How long does that take?
takes about 2 weeks, okay, to get the full approval. When I say full approval, meaning underwriting, sorry, it gets underwritten. You have
Oh.
verification of employment, tax return, and social security. We pretend like you're under contract and knock it all out. So as soon as we pull credit on somebody, my next step is to get it fully approved. Even though they may not be looking for a bit, if I have it fully approved, that random Saturday, I'm gonna look at something, oh my gosh, it's done. And I always submit it for more than what they want for maximum approval. It's guaranteed they might sign something they like, and if we don't have it fully approved, then I wanna make sure it's done. The only, and the other thing that really, certified mortgage ready is great. If you work at pay stub W-2 and the debt to income ratio is easy, not a problem. But when we do jumbo loans, we're pushing a debt ratio, self-employment, multiple rental properties, all this stuff, I wanna have it fully approved because if I'm glancing at it, I'm not an accountant. I'm not the person who does all these loans, right? I mean, approves all these loans, but I do have 20 years experience and I know when I need to get it approved. Okay. Sorry.
Once it's fully underwritten, is a rate locked in for a period of time?
We can't lock the rate until we get under contract on the house
But
because we
do have a
don't know.
program That you can block the interest rate.
That's-
Yeah,
The lock and shot.
block and shop is what it's called. There's a cost associated with it, but you can save an interest rate with like a float down feature if it comes down before you find a property. There's just a cost.
So
Yeah.
once they're fully underwritten, how long does that stay at that? Does it like expire after a couple months or what?
Yeah, so it expires typically in 30 days because we have to get.
You
pay
gotta get
stubs
new pay
and
stubs,
that
new
stuff,
bank
but
statements.
that's pretty easy,
Yeah.
right?
Yeah.
And then, it's as good as the credit report.
Okay.
Yeah,
Yeah, the credit report's good for 120 days.
yeah.
So the biggest thing is that on the letter that we write, every letter we write says it's good for 30 days.
Mhm.
As long as we get an updated pay stub and a bank statement, we're good. I'm gonna write the letter I mean, nothing's changed, right?
Yeah.
Yeah.
But if it's
And-
self-employment and these other things, and we got taxes, and especially in April and October now, because taxes are due. You know, we gotta make sure those are dialed in, especially self-employed, multiple properties, jumbo. Get them fully
Do you
approved.
remember how long I was in that,
You,
in that queue, Aaron? Weren't we in for like 8 or 9 months?
For you, when you buy your place?
Yeah.
Oh, yeah, I had them fully
I
approved.
was fully
I was like,
approved for
Eric,
like-
you gotta sell another house, man, to get. I'm joking.
It was like forever.
Yeah,
Dude, that was like back when everything was selling like hotcakes. And
Yeah.
I got lucky, like when that, like back in, what's that, 18, when we had that crazy snowstorm.
oh, yeah, yeah,
We
yeah.
went out and started, and they builder just put the house on for a Friday, and the snowstorm came that night, right after they put it on, so I went and.
But we had
they
it
came in and
approved,
said,
so
"Oh,
it wasn't
close
an
in 10
issue."
days."
So when I'm nervous with Eric, the office
They
leader,
did.
like, don't screw the loan up, well, I don't have to worry, like, it's already been approved.
Mhm.
It's screwed up proof. So,
This is, I mean, this is definitely something that, the buyers these days really should do. Because of the competition, because we're still seeing multiple offers on a lot of stuff.
mhm.
I mean,
And
there's,
if you're asking for seller credits, and
Yeah.
you wanna like get creative to create affordability, having somebody fully underwritten. It helps in negotiating.
Mhm.
but yeah, I mean, I understand that you're not gonna have everyone fully approved, but if we pull credit. My job is to get that fully approved because if we can get it done, there's no cost to the buyer. And in fact, it costs us, I think, $600-700 to process every file that goes through the full underwrite process, even though we don't charge the buyer for it.
Mhm.
So it's free. So why wouldn't you do that? Why wouldn't you put that extra layer of protection on there? And then if we have to close, or if you have to be aggressive, hey, we need to waive financing, we need these certain things, I'm much more easy to do it when we have it fully approved. Right? The worst is when like, hey, we gotta waive everything. I haven't seen the file but once. and, you know, I got hurt.
Yeah.
It's not good. 50,000 earnest money, non-refundable, awesome.
So fun.
But yeah, but that's the idea. I mean, working as a team and everything else. And you're right, we do have that lock and shop program. There's a way that you can lock in the rate for a period of time, and if you don't, it kind of goes away. But again, it's depending on what works best for the client and everything else. But yeah. I mean, the refi 5. I mean, I'm telling you, that'll be big.
And does everyone know what goes into a refinance? Okay, I mean, typically you're still proving you can qualify at that new interest rate. So if nothing's really changed credit wise or job wise, then they're qualifying for a lower payment. They're gonna do pay stubs, W-2s for 2 years, you know, and then bank statements if they're bringing cash to close, but you can roll it into the loan, so you don't necessarily need to do bank statements, so,
And if you have enough
Credit.
equity in the house, you might not have to get an appraisal.
yeah, you have enough. So, you know, it's pretty straightforward, easy going, and you can do it in about a month. Yeah. So,
Next.
super easy.
And then the marina.
And there has,
I do.
with the refinance, there has to be a benefit, so we have to show the client that there is a benefit. So they can't just refi for no reason, you know, and save like $50 or something.
Oh,
It's like,
my goodness.
There's not,
Yeah, there's
Yeah.
this form called the net tangible benefit
Benefit.
form.
yeah.
Like, why would you refinance if there's no benefit?
Mhm.
Don't you have to have a form that says there's a benefit to refi?
Yeah.
Why would they?
It's the same, yeah, I don't know. But any questions on this stuff? I mean, I know we went through a lot, but the idea is just, again, at the very beginning, like, how do we provide knowledge? How do we provide comfort that it's okay to have it's okay to buy, right? How do I get someone who doesn't want to pay $4,500? How do we show them that maybe you can, or maybe put on the radar? So maybe in 6 months, they decide to buy if rates come down.
Mhm.
So that kind of thing. So just any help or any way that I can help you guys. We were discussing different ways to do that. If you talk to somebody, we're talking about, do we have a Calendly thing we're gonna put on the door? So if you have a client that just wants information, I don't want to be salesy with it, right? I just want to be like, hey, look, this is how it works. Let me know. And then easy to put on a calendar. We can do a quick call
Mhm.
and just say, look, it's just knowledge. It's not sales. It's not this. And I think if more people are receptive to having a mortgage guy to call, it's just gonna give them information.
Yeah.
Rather than trying to put them into a loan. I think that may be helpful for everybody, you know, so I'm just trying to figure out how to do that.
Your mouse and see if there's questions on Zoom.
Oh, Zoom. Zoom questions?
No, nothing.
Any questions on Zoom?
No? Anybody in Zoom have questions? I guess we're pretty quiet today.
Is this somewhat helpful?
Yes.
Yeah. This is what we do. We're not, you know, again, you know, we're not the hard charge and sales guy. What we want to do is provide knowledge so your clients feel very comfortable making their decisions. And once they do that, they'll make it, it's easy to get sell.
How do we get a copy of the overhead, please?
We can.
You just email it to,
that,
you.
yeah,
That'd be okay?
Thank you. That would be great.
of course.
Nice.
Hand deliver it.
All
Yeah.
right, any other questions? You guys did?
There's bagels back over there too.
Good stuff.
Yeah. So next month, do we have a topic for next month? Did we come
I
up with
don't
one?
think we've workshopped that quite yet.
We will workshop it and we expect to see you here.
Nice.
If you find knowledge in this, let other people know that it's fun to come here. It's easy going, open up. I mean, it's nothing formal, you know,
Mhm.
so. But
I like it. I like it. Thank you, guys.
yeah.
Yeah, of
That's
course.
awesome. It's nice to see the differences and stuff like that.
Yeah, it's get in front of people where they're comfortable and not feeling all, you know what I mean, like tensed up because I feel like you're trying to get me into the house, you know?
Yeah, well, I mean, that's the thing that we have to continue to have conversations, you know, the more that we can have conversations to let people know.
Yeah.
You know, this type of
And
information, like, it
Yeah.
could completely change, you know, their decision making.
Mhm.
yeah, and I think Lee and I were talking about trying to come up with some like flashcards or something that you would have that you could hand out. So just something, you know, like what did we just talk, there's bulletproof, I mean, real simple,
Yeah,
so you
like
can hand something to like the lady at the
Yeah, like-
dealership.
the headlines right now, like, you know, mortgage rates are the highest that they've ever been, you know, home prices are as high as they've ever been. And, you know, I just feel like the news cycle can sometimes
correct.
affect people. And really, it's such a good time right now because you can negotiate and create affordability and there's less competition. You know, people were, you know,
Yeah, just like last November, I
overpaying on
just,
houses and.
Yeah.
cause after the beginning of the year, all that went away, right?
Mhm.
I remember I had people like, hey, let's offer 30 grand less or do the temporary buy down or whatever it is. They were more receptive to it, especially if you got the listing. That's the other part. If you, before you start dropping,
Yeah.
start talking to us,
Yeah.
because then we can tell you exactly, like Deep just did that on Friday, right?
Yeah, I know.
And I think I have a buyer for him too.
For real?
Yeah. He
Awesome.
called me on Sunday.
Wow.
Because we look at this duplex in Seattle, I'm like, is in Capitol? He goes, yeah. I'm like, okay.
I know a guy.
I know a guy. Who knows a guy?
Yeah, so yeah. But that's the kind of thing. So I just think before you list, before you drop your listings, talk to us and we can give you, see what it'll look like, do a scenario like this. And you can save 15,000. Right, it's only do drop at 15 versus the 100,
Mhm.
maybe it makes sense.
And I have like flyers that you can keep at your open houses that show, you know, dropping the sales price by 20K versus asking for a seller credit and doing a temporary buy down. What are those payment difference? You know? So,
Yeah, I would almost like do a flyer for like any open house and say, you know, especially one that's been on the market.
Well,
for a
yeah, I
little
don't know if
bit.
you want
That's
me
the
to do
thing,
that
like,
right when
maybe
you
the
list
first
it.
Weekend.
Yeah.
Yeah, I don't think the seller's gonna be all stoked to see a flyer
So,
show up like,
you know.
hey, seller's gonna give you 25 G's. You know, they're probably.
Unless they
not
wanna
gonna-
move it
yeah.
quick, you know?
Or what
Would
you
be
do,
happy
the
about
other
that
part
one.
is like you do at grocery stores or sales, right?
Okay.
Overprice it, price the 25 in there, offer 25 grand, you know, put it in for 25 grand more and say, look, we'll offer you 25 grand off the sales price or off the, as a seller concession. And you do the same thing we just talked about the last time.
Yeah, I mean, most people are payment conscious. That's typically the thing, like, how much is this going to cost me
Mhm.
every month? And how much do I have to bring
Yeah,
to the table to
Yeah.
close and get the place,
Yeah.
right? So if you can do flyers that shows that scenario, say your price can be this to
Per
buy this home.
Yeah.
Yeah.
I think that would be a really good hook for them.
Mhm.
People
Yeah.
just go, how does this work?
Yeah.
Like
Yeah.
you show the end, you know, the like what it can be.
Yeah.
Mhm.
Let them start asking the questions. Say, yeah, well, instead of us reducing the price, the seller decided to offer a credit to buy the interest rate down so that
Yeah, yeah.
we know that the buyer can afford more.
We know
Because
that
the
the
first-
affordability is an
Yeah.
issue with a lot of
Yeah.
houses right
Yeah.
now.
well, that's the thing. The first one everyone goes to is that price overpriced.
Yeah,
Like, well, okay, well, it's not overpriced. What's the payment? Like, how
right.
do we get that payment? And I think it almost feels like when you go to the car dealership, right? A lot of times they're saying,
They're pushing.
where do you push payment? And you're
Yeah.
like, well, I don't wanna. But on the house part, yeah, exactly, exactly.
Yeah.
So the same thing with the house. So
Same thing.
when that happens, when everything started changing, it took me, I had to have a radical change in my mind. The pay points, to do the buy downs,
Yeah.
like, why are you doing this? How the rates are so high? And then you just realize it's about affordability and what people are willing to pay. And
Yeah.
if you can get that number to where it needs to be, the rest of the stuff will take care of it. The appreciation, you know, the payment of the mortgage and everything else will do that. So,
Mhm.
yeah.
Awesome. All right. Good stuff. Thank you, guys.
everyone.
Josh, next time.
Oh, my leg.
Yeah.
Again.
Yeah.
You can
You know,
stop
I
here.
was,
What do I do?
somewhere, I don't know if I read it or heard it, but almost 70% was in the high 60s of first time
Oh, there.
buyers. Believe
What
that
about
you have to
recording?
have at least 20%.
Yeah, oh, yeah.
Right.
That's
And
true.
even at an open house, if there was a one pager that might say, here are the different loans,
Mhm.
interest rate, down payments,
Mhm.
and here are all the strategies.
Mhm.
Yeah. Oh, that'd
I
be
think
cool.
that would be very useful.
Something where like, okay, you can do 3% down up to this loan amount, 5, 10, 15, anything in between.
Yeah,
Yeah, and then,
well, for sure, like the whatever the government loans are, and
Yeah.
then for sure the
'cause you can go.
20%, then you wanna show them what a 20% maybe loan is. I think a lot of websites even start out like that.
Yeah.
You only have a lot of times minutes to develop